team, and then we kind of take it ahead, Akhil. I think,
Okay.
Ricardo, you're going to do a short introduction, or is Naman going to do it?
So I'm going to start, President, and then I'll hand over the baton to Ricardo. Ricardo will formally introduce everyone and then start the session.
All right. We're pretty excited to hear, Akhil, so everybody else keep it short.
A big happy hello to everyone, to all the participants, attendees of the Cheat Code to Real Estate Property Cycle. I am Keval from CREDAI MCHI, and I would like to personally thank all the people who are attending this program today. And I would personally like to thank the President of CREDAI MCHI, the other MCHI members, distinguished members, and the non-members as well. A very good evening to all of you. And big thank you to our youth wing to organize this particular program today. I would also like to introduce our co-host and the host, Mr. Ricardo. The co-hosts are Aditya Mirchandani from Mirchandani Group, and he's also the managing committee member of CREDAI MCHI. Binita Dalal, she's the head of finance in Rustamji Group, and also a managing committee member of CREDAI MCHI. Mr. Naman Shah from Shri Naman Group, and also the youth wing convener of this particular year. I would also like to thank Mr. Ricardo Romel, who is also a managing committee member of CREDAI MCHI and our, the head of this particular program. And I thank you, Ricardo, for your active participation. And I give you the floor to introduce the chief speaker today. Thank you.
Hi, good evening, one and all. I'm Ricardo Romel, as Keval has already announced. Thank you, Keval. This is the Akhil. We'll move on to you very quickly, but a quick introduction as to why we are doing this. There's an old saying that the past does not repeat, but it certainly rhymes. And whether we like it or not, history has a strange way of teaching us that the lessons of the future are often written in the past. Today's session aims at uncovering such lessons, and I think knowing Akhil and property share market economics, the kind of research you guys have done, I think you guys have a lot to share towards the oncoming uncertainties. A brief introduction about Akhil. Akhil Patel is the director of property share market economics, and for the last few years he has been working with Phil Anderson, who is the author of this fabulous book, The Secret Life of Real Estate and Banking. The book is a comprehensive interplay of how markets work with real estate, work with all other work in the larger economic cycle, and why things go boom and bust. And it's a must read for everyone involved in real estate. Akhil himself, on the academic front, has 2 master's degrees from the University of Oxford in UK. One in classics, which is actually history as we refer to it in India, and the other one is finance and public policy. He's also part of the European Bank Reconstruction and Development Board, where he's the principal policy advisor. Without much ado, I'd actually now move the spotlight to Akhil. And Akhil, anything you'd like to open up with?
Well, thank you very much for the kind introduction and for inviting me to speak to your distinguished event. So I just add a bit more about myself. So I'm, as you can probably tell, of Indian origin. My grandparents are from Gujarat, and they moved to East Africa, to Kenya in the 1940s, and then moved back to India, to Baroda in the 2000s. And so I am somewhat familiar with India, but only a small part of it. Unfortunately, I'm not a very detailed expert in the ins and outs of the Mumbai or the Maharashtra property market. But in any case, my talk today will focus on the very big picture. And I think, as you said, Ricardo, it's very important that even if you're making day-to-day decisions based upon the fundamentals in a particular location, and as real estate developers, you're all doing that, you need to have an eye on the bigger picture. And I believe that the framework that is articulated in Philip Anderson's book on real estate, as well as some of the points that I'll make today, are really fundamental to understanding how the economic system works and therefore what's going to come next.
Ricardo, you're on mute.
Sorry about that. Akhil, we have a lot of questions to ask you, and most of these questions are aggregated from our members. And what we've done is, we're not really a panel of people. We're just trying to sort of intertwine these questions into the large narrative and the output which you put forth. So,
Okay.
and first of all, I'd like to ask you very honestly, is what got you to understand such a macro trend, considering that real estate really is a bunch of smaller micro markets. And a lot of deviant behavior within those markets. Why would there be a need to identify such a micro trend in the first place?
Well, I mean, it's a really good question. So fundamentally, you're right. Real estate is a very much a locational asset, and different locations do different things at different times in relation to price appreciation and in relation to supply and demand of units. But if you recall, and this is where I became interested in economic cycles, if you recall in 2007, 2008, we had the global financial crisis and everything went down and no one could obtain finance and people stopped buying, people stopped selling. And there was a prolonged period of global uncertainty. Now, I do appreciate that different countries experience that in different ways. And so what happened in the United Kingdom, where I'm based, might have been different to the way that we experienced in other countries, but nonetheless, it was a pretty significant financial crisis. So while it is true that there are sort of micro markets and micro trends and so on, ultimately we all are subject to the same overall economic cycle. And the reality is that after, particularly after the Second World War, as economies develop, they're becoming increasingly synchronized, and they go through the same periods of boom and bust at roughly the same time. It's not precisely the same time, but it's pretty close. And so those who are, even if they're involved in a particular market, they need to have an eye to the bigger picture. And that's how I became interested. So just to add that when the global financial crisis happened, no one seemed to really forecast it. And I thought that could not be the case, that something so big had been unforeseen. And I wanted to find out why that was and what to do about it, such that I could help, my family's business, because we have a pharmaceutical business in the UK, but also other businesses we could help understand these things and advise them accordingly. I think
Phil's book did cover that well in advance, if I'm not mistaken, along with Fred Harrison's book as well. But moving on to the more poignant question, what is this 18.6-year property cycle? How was it conceived, and what is the basis for such radically different thinking? So,
I've been doing it for so long that I don't feel it's radical. I think it's radical not to know about it. I'll just share my screen. I'll just make a few overall sort of remarks about the cycle and how it's structured. I mean, I could be talking about this for a very long time if you allowed me to. So I'm just going to give an overview and then we'll go back to your questions. So allow me to share my screen. So I'm going to just give a very brief overview, as I mentioned. It's an 18-year real estate cycle. Now, you might think that you've never heard of it, and that might be the case. And it's more apparent in some countries than others. It's very apparent in the UK and the US, which have existed in their same sort of form, more or less, for several hundred years. It's less apparent in newer countries, which, for example, in India, which until 1947 was subject to, the British and other countries have been broken apart over that time. They've been put together and so on. And so that has obviously a major disruptive effect. But when economies get onto a sort of pretty sure footing and they start to develop and grow and people become more prosperous and people want, better quality of life for themselves, you start to see the same patterns. And essentially what the proposition is is that there is an overall 18-year cycle. It's roughly, as depicted on this rather basic diagram, it has to be said, roughly 14 years up and 4 years of kind of crash and crisis and then recovery. And of the 14 years expansion, that's also it can be subdivided into two halves of roughly 7 years. The first expansion leads out of the previous cycle and the previous crisis into a mid-cycle slowdown, which is the middle blue bar in the diagram. And that mid-cycle slowdown is often a recession, but it tends to be relatively short and things don't crash very significantly. And then you come out of it into a second expansion, which tends to be bigger, growth tends to be higher, asset prices tend to appreciate more quickly, there tends to be much more available credit and lending by banks, much more bullish and euphoric sentiment. And that is where things really lead over the top to a peak. And then when the cycle turns down, the crisis after it tends to be very significant. Not least because there is much more leverage in the system, and all of that has to be unwound. And the banking system is under pressure. They stop lending to businesses. Businesses don't have credit. The economy contracts. When the economy contracts, people are laid off, and you get a major recession. And so the recessions that you tend to get in the economy are not equal. It depends on where they take place within the cycle, and we can come on in a little bit to where we are now. Now, that is a relatively basic structure for the cycle. And you might think, well, it can't possibly be the case that it's always 18 years. Well, let me take you to the next diagram, which is depicting land sales in the US from 1800 to 1923. Now, just a bit of history. So when the US gained independence from Great Britain in 1783, the states got together, they ceded any claims to the Western lands, i.e. the lands across the continental United States, and it was settled over a period of about 150 years, beginning in 1800. And so what you used to do in those days is you used to go to the frontier, you used to mark off a piece of land, you'd go to the local land office, you would acquire title to that land. And if you needed to, you'd have to borrow from the local bank. And what happened over the course of a few years is that, there'd be a steady volume of land sales. And then suddenly at some point, there would be a massive crescendo in activity. And then there would be a major peak. And then the volume of activity would decrease markedly. And actually, at the same time, there would be a major financial crisis. So there was steady activity and then a major peak in 1818 and then a financial crisis in 1819. Things then recovered a few years later. There was a steady activity and then a major speculative boom into a peak 18 years later in 1836 and then a major collapse in 1837. And so on again into 1854, into 1869, a land boom after the US Civil War, in 1888, and then in 1908. And after each of these events, there was a major banking crisis and a relatively prolonged recession. And so for the first 123 years of US history, there was this 18-year periodicity of sort of steady activity, then boom, and then major financial crisis. It wasn't just in the US. This graph is taken from Phil's book. Fred Harrison, another economist who actually has been researching 18-year cycles even longer than Phil and I have, pointed out the same 18-year pattern in the UK going back even longer. It doesn't lend itself to quite so clear a graphic because we didn't have the same program of land sales in the UK as they did in the US. Now, what happened after 1923? Well, the frontier was closed in the US, and so there was no more kind of real selling of public land. It was the first cycle where actually all the land was enclosed. And yet, even though there was the First World War in between 1914 and 1918, even though there was the major Spanish flu pandemic in 1919 to 1921, you got the Roaring Twenties, which was a major land boom, probably the most celebrated boom in history, to a peak in 1926 in terms of real estate. The stock market continued a couple of years longer into 1929. And then we had the major financial crisis, the Great Depression, and so on. The 30s were a pretty dark period. After that, we had the Second World War, and then there was reconstruction in Europe and in other countries. The US economy was demobilized. And from about the mid-50s onwards, and now using the proxy of house prices in real terms, there was steady activity in the 50s and 60s. And then towards the end of the 60s, a major rise in property speculation and bank credit to a peak in 1973, and then a major financial crisis. Now, those of you who know your economic history will say, well, the 1970s was all about the oil shock. This is one of the reasons why people don't see the cycles, because they don't attribute the right events to the right things. And actually what it was a land-led crisis that was causing problems in the economy, that was actually causing the economy to turn down, which was a key thing. And then the oil shock happened on top of that to make things worse. Nonetheless, after the 1974 oil shock and the 1979 one, things recovered, and we had a pretty significant boom into a peak in 1989, and then a major banking crisis, which no one seems to remember, took place in the early 90s. And what was interesting of the activity particularly in the 1980s, also to a certain extent in the 1970s, was not only were you seeing this phenomenon just in the UK and the US, you were starting to see it in other countries in Europe, in Germany and France to a certain extent, but also you were starting to see it in places that had been, pretty significantly destroyed during the Second World War, like Japan. And in fact, the 1980s boom in Japan was possibly the biggest boom that any country has ever experienced in history, and of course led to a major collapse so significant that it pretty much took Japan 20 years to get out of. Nonetheless, across the world in the early 1990s, things recovered. Then we had another property boom in the 2000s to the peak in 2007, 2008, depending on the country, and then a major financial crisis, which was the global financial crisis. And it seemed that most large economies were going through the same thing at the same time. And so the point earlier that I made was that what might have started out as a UK-US phenomenon actually became a Western one and is now a global one. It's not something that just affects real estate. It's also determines to a large extent, but not the only extent, stock prices. So here I've taken stock market data from 1800 in the US, and I chopped it up into 18-year segments, and then I averaged it out. And what you see through that is a pattern very similar to the fairly basic illustration of the cycle that I gave you earlier. So the first half expansion, then a mid-cycle slowdown where stock prices don't go anywhere, or they go down and go up again. Then a second half expansion, which is more significant, then a peak, and then a major crash, which takes at least a couple of years for the stock market to recover out of. Now, this is a relatively basic framework, and there's so much more detail that we could go into in the questions, but it is something that you can use to forecast. And on this slide is some evidence of that. So in 2004, my friend Phil made a forecast to his subscribers to the service that he ran at that time. And he said in 2004, so well before the financial crisis, that he expected the cycle to run its full 18-year course as normal, with speculation in the US to reach fever pitch by 2007, and a credit event, in other words, a financial crisis, to unwind things in 2008, which is exactly what happened. And it wasn't just Phil who said that. Fred Harrison also made that similar forecast in the late 90s, early 2000s, based upon knowledge of the 18-year cycle. In October 2008, when everything looked pretty bleak, when Lehman Brothers had just collapsed and stock markets were at least 50% off their highs in 2007. Phil wrote the cover story for Money Week magazine, which is the largest financial publication in the UK. And he said that actually there's going to be a recovery after 2010. And he illustrated how that would be. And then in 2014, Phil and I also wrote a cover story for Money Week again. And we said that while things were recovering, they would continue to do so to the end of the decade, and that we'd find economies slowing in 2019. Which is exactly what happened. Now, we talk about the COVID pandemic as being the cause of the recession. In fact, the global economy was slowing in 2019. PMI data was down, particularly export-related economies The yield curve in the US had inverted, signaling that there was a recession coming. And then, of course, the pandemic made that very significantly worse, at least for a few months. Of course, the response to the pandemic was also very significant and ensured that the recovery would be relatively swift. So where are we headed now? Well, the current cycle, the last cycle ended around 2008. Then there was a 4-year period of crisis and recovery. So the current cycle started in 2011, 2012. Now, I actually created this graph in 2016 just to help illustrate where things are. And all I've changed to this is move the yellow dot 1 year at a time. And so we had the end of the first half of the cycle in 2019. We had the mid-cycle recession in 2020, and we started the second half of the cycle thereafter. In 2016, I said the way that we get out of the mid-cycle recession is much looser monetary and fiscal policy, i.e. very big packages of public spending and very low interest rates, exactly what we got. One of the ways that governments stimulate their economies is to spend money on infrastructure, is exactly what we got. When you get major infrastructure spending, you get a commodities boom. We've had the first leg of that. Commodity prices are coming down now, but they will recover at some point and they will follow the second half of the cycle up. What we will get in the future, well, one of the things that doesn't happen at the mid-cycle slowdown is a major banking crisis. Banks are relatively resilient. People think all the banking regulations are working. Property prices haven't come down very significantly, so bank balance sheets are relatively healthy because, of course, property is a very major source of collateral for banks, at least in developed financial markets. And so that leads to a lot of competition to lend. And so it becomes an era of very easy money, which is to a certain extent one of the reasons why the property boom in the second half of the cycle is very significant. At some point with all this, with land prices rising very significantly, with credit being very available, someone somewhere will announce the world's tallest building. It's not not without coincidence that Mohammed bin Salman has just announced this ludicrous 75-mile mirrored land scraper across Neom, the area that it shares with Egypt and Jordan. Maybe that's the thing. Maybe there's something even more outrageous coming along. But it's always announced in the run-up to the peak. The peak should arrive around 14 years after the start, so 25, 26. And then we will get a major financial crisis because the banking system cannot keep pumping money into the property market. At some point, the economy can take it no longer. And then things start to slide. Once they start to slide, they affect the banking system. Banks start to fail. And then you get a major contraction of credit. When the economy lacks credit, it starts to fall down in a fairly major way. And so you take quite a long time to get out of that crisis. And so 4 years after the peak will be the end of that sort of crisis phase. And it's usually at that point that the world's tallest building opens. And of course, at that point, they can't find any tenants. And if you think that's a rather glib thing to say, well, take a look at history. So on the right is the Burj Khalifa, which opened in 2010 in the middle of the global financial crisis. On the left is the Shard, which is at the time was Europe's tallest building, also opened in 2011, 2012 at the end of the crisis. If you go back a little bit, the Petronas Towers in KL opened in 97 during the East Asian financial crisis. If you go a bit before that, the peak of the last cycle in Europe, we had Canary Wharf opened in 91 in the banking crisis. The cycle before that, this is the Willis or Sears Tower in Chicago, which opened in 1974 during a financial crisis. And perhaps most famously of all is the Empire State Building, which opened in 1931 in the middle of the Great Depression, and they couldn't find any tenants. And so for the first few years, it was called the Empty State Building. So this has quite a long historical provenance. It happens over and over. We've seen that we are more globally synchronized than ever before. And that as economies develop and grow and sort of become more integrated into the global financial system, for example, Japan after the Second World War, they also exhibit the same cyclical pattern. And my hypothesis is that they will do so at the same time. It's not a given that they follow exactly the same dates, but that's my working hypothesis. And so what we do for our subscribers and our investors is we essentially track the cycle for them, and we provide up-to-date analysis of where the cycle is from a macro point of view. And investors and developers and business owners in other countries are very lucky because the US tends to lead the cycle. And so what happens in the US in cycle terms tends to be about 6 months to a year before everyone else. So if you follow what's going on in the US, you have plenty of advance warning about what's going to happen in your own economies. So I think I will stop there. I know that you've got plenty of questions. You want to sort of relate some of this information back to India and back to the current situation, which of course you'll tell me that with the possibility of nuclear conflict in Ukraine and the fallout of the property market in China, and you also tell me that with inflation so high and various other things, that of course the cycle is not repeating as it has before. And I will tell you to spoil the punchline, I will tell you that it's repeating with quite remarkable precision. Anyway, let's go to questions.
Aditya, if I could just interject, and sorry to take away, just to give you guys how crazy the NEOM tower sounds. It's 200 meters tall and 75 kilometers wide. And I don't think we've ever heard of something that magnanimous. But on to your question, Aditya.
So Ricardo, correction, it's 500 meters tall, 200 wide, and 75 kilometers.
I stand very much corrected.
It may not, it may not see the light of day, but at least not in the next few years, because there've been a lot of announcements. They've been talking about NEOM since at least 2016, and it's not exactly on track.
Right. So Akhil, thank you so much for the insightful presentation. We have a lot more questions, but just to start off broadly, if the cycle is so accurate, why, and it has been going on since such a long time, why doesn't anyone else see it?
Well, the fundamental reason is that no one really studies land as a separate factor of production with its own unique characteristics. So we don't, you developers will know the price of land in your local markets, but at an aggregate economic level, it's never really tracked. And it's fundamentally a land cycle. So when property prices rise, it's not the value of the building that's going up. It might be subject to slightly higher reinstatement costs because of, rising cost of materials, but essentially other things being equal, the rising cost is the rising value of land. And it's where land is speculated in that you get the cycle. But of course, economics doesn't really deal with land, and so therefore doesn't see the cycle. And actually, as I point out in my forthcoming book, the reason why economics doesn't consider land is actually rather deliberate. And so it's almost a deliberate blindness in the profession. But if you don't see land, you don't see the cycle.
Got it. And you talked about the 18.6-year cycle quite extensively in the presentation. But today we live in an extremely super-paced world. Do you think going forward, this 18.6-year cycle might actually get compressed to a shorter span?
Well, it's a good question. I get asked that a lot. We do live in a super-paced world, but I don't know. If you think how much the world changed between, for example, 1837, when the first train was run, and the end of that cycle, when you could essentially cross the entire United States in 3 days as opposed to 3 weeks. I don't know if that extent of change is less than what we're having now. So I think that's the first point to make. But the second is that, there is some psychology involved, and it seems we need 18 years to forget all the lessons of the previous cycle and go through the sort of the mid-cycle slowdown. To a certain extent makes us forget because we've dealt with the mid-cycle challenge, which is very different to the financial crisis. And so we get a sense that we're living in a new era. It also takes quite some time for technology to be absorbed while, for example, one of the key drivers of the current cycle from a technology point of view is the smartphone and 4G. It's really only in the last sort of 3 or 4 years that you've seen the real connectivity and the real level of application that has sort of fundamentally changed the economy. So some of these things take time to build. And of course, it does also take time for the leverage to be built up in the system, which ultimately tips the cycle over the top and causes the major crisis at the end.
Right. Naman, do you want to take the next one?
I think Benita had an important question in mind.
Yeah, so I think we can come back to mine.
Hi guys, Saruj. So Akhil, I have a small question with the India-Ukraine war, and sorry, the little noise where I am right now. I'll just get back to this question. Ricardo, you want to take it up?
Sure thing, Benita. So the present Russia-Ukraine situation, do you think, Akhil, that it has, with it putting as much pressure on trade routes and especially oil and thereby commodities, we have inflation going double digit or looking to go double digit. We have rising interest rates.
Yeah.
Do you think this, do you think rising interest rates is a way to control inflation? And what's your overall view on all the disruption going on right now?
Well, it's very disruptive. There's no question about it. I mean, I don't want to give the impression that the cycle only happens when things are okay, because if that were the case, there's pretty much no 2 decades where everything's okay. I mean, I know that we haven't had inflation like this necessarily for a long time, but we did in the late 60s and 70s. We have had a cycle where there was a world war in the middle of it in the between 1914 and 1918. We've had a cycle where there was a major, much worse, more significant pandemic, which killed tens of millions of people, which obviously had a huge impact on demographics between 1919 and 1921. We've had US civil war. So we've had all sorts of things. The cycle has endured through all of it. Do I think that some of these variables will affect how the cycle plays out? Of course they will. Of course, the cost of money and the cost of capital affects real-term business decisions, what people build, where they build it, how quickly they do it. But ultimately, what it doesn't do is change the incentive to speculate and make money out of, real estate speculation in assets, and so on. And that is ultimately what drives the cycle. Sometimes it might happen when fewer people are fully, kind of exposed to the real estate and the banking sector. Sometimes it's maybe more global when everyone is involved in it, and somehow through, say, securitized lending, even large pension funds are exposed to it. So the circumstances in which the cycle repeats might change, but the fundamental drivers do not. The only way that probably it would stop is if we all became communist and economies and weren't allowed to own anything, and there was no pricing mechanism, there was no sort of functioning banking sector. I think that those are the only circumstances when the cycle is really interrupted. So there's none of which is just downplay the seriousness of the events and the difficulty it might make to certain businesses. But from a macro cycle point of view, it doesn't change anything.
Hi, Akhil. Good evening, Naman. How are you doing? Just wanted to really quickly, since you touched base on banking, wanted to understand what is the relationship between banking and real estate, and how do they interplay within the cycle?
Yeah, it's a good question. So, at least in Western economies, most of what banks do is lend for real estate. So it's a fundamental symbiotic relationship. When you get a property boom, the value of the collateral against which most bank lending is secured is doing well. So banks look robust and they're very profitable. Incentives within banks to do more business encourages more real estate lending. As there is a greater supply of finance for real estate against, in most locations, the supply of land is relatively fixed. And so that pushes prices up even further. And so prices become subject to how much banks are willing to lend. At some point, an economy can't keep taking rising rents and rising property prices. There's just too much squeezing going on households and businesses. And so that dries up activity in the real estate market, which then starts to put pressure on prices, which then starts to cause a few defaults. And because banks are then having to manage their balance sheets in a falling property market, some of them start to collapse. Then there's a major panic in the banking sector, and then the economy is starved of credit, and so there's a major recession. And so it's a very symbiotic relationship. It's the property market that brings down the banking system, essentially, and also permits its major rise.
So, Akhil, I guess that answers your question, Naman.
Yes, thanks.
Yeah. So, Akhil, we thought we just present to you a scenario here, and based on certain data from the stock market largely and how it's reacted in the past in correlation with the US stock markets and the news coming out of the US itself. So we are trying to see, would you think that this is a situation where we could say, yes, India to a large extent is correlated more than ever before? We've got a couple of charts which we could like to present to you, and for some reason it's drastically similar. I think Aditya would like to explain some part of it.
Yeah, so in this first chart, we see that...
Sorry, Aditya, just one sec.
Yeah.
Harish, if you can make it maybe full screen or just maybe make it bigger. Is it clear to everyone?
Yeah, cool. I can see that.
So
Okay,
this chart basically highlights the RBI interest rates, which is in blue at the bottom, and the stock market, which is at the top. And we can see that the RBI increased interest rates about 4.8% 18 years ago, and the reaction was a 400% rise in stock markets following that. We're at a similar point right now, where it's about 4.8%, and we're expecting the RBI to again increase interest rates. So how do you see it going forward from here?
Well, I don't think the causal factor is because rates rose, stock prices rose. I just don't know. I don't think there is a causal relationship, but we are at the point in the cycle where prices should be rising, and the stock market rides the cycle up to a peak, as I showed with the Dow Jones since 1800. And so as it did in 2004 to 2007, I'm expecting exactly the same in 2022 to 2026. So yes, I do think it will be a repeat, and it will be against the backdrop of, possibly rising interest rates. It may be that, we've seen the worst of the rates, at least in the US now, or at least it seems that the market reaction to the Fed's announcement yesterday suggests that it was already priced in. So there was a bit of a rally out of the lows. I don't know if the lows are necessarily in, but it seems that we're getting close. US markets tend to lead others, as I've said. And I expect US markets to boom quite significantly. Through a technical analyst, actually, the chart of the Dow Jones and the chart of the BSE Sensex is actually incredibly bullish.
Yeah, I think Naman, you had something.
Ricardo, could you just go to the next slide?
Harish. Sorry to cut you off, Akhil. But in line with what you were saying, and Naman, you had an observation about this.
Yeah, I just wanted to add, Akhil, a lot of us might not remember a lot of the funds and finance companies started investing heavily into real estate around, the 2004, 2005, time frame. Which we may remember as like the mall craze, and thereby Indian real estate saw a similar boom and bust to the United States. So if you can just add a bit on this.
Well, there's always something, there is some asset which absorbs the capital, because that's where people are feeling the demand is. So malls, yes, I remember seeing some in where my grandmother lived. She's now passed away, sadly, but where she lived, a lot of them opening up. I don't know enough about the real estate market now to know what that will be this time around. It might be something else. It might be related to technology. This is how technology might affect the cycle. So, if there's new demand for locations based on a different technology, I don't know. But there's usually something. In the UK, we're seeing a big boom in logistics centers because online economy is developing. So you need space to store goods in local locations. There's actually been a bit of a revival in smaller town centers because people are moving out and can work remotely. So that's changing the patterns. But there's always something that happens over the course of an 18-year cycle.
I think what we're just to show how well correlated. Yeah.
Sorry. Ricardo, you want to say something on this? Or?
So we also have something called a housing index, and it's at a relatively infant stage still. Started since 2012, but it's been seeing steady growth. And while it's not on par with UK housing, the UK HPI and the US HPI, it has recovered from its COVID lows. Do you think the graph represents, something of past which might be correlatable?
Well, I mean, it's difficult to talk definitively about a specific cycle in India without, obviously seeing data and knowing the history. But if you were just to present to me this looks very correlated to the US and UK real estate cycle. So you had lows around 2011, 2012, and if the data series went back a bit further, you might find the same thing. I presume that housing prices weren't going up and probably were going down in 2008, 2009, 2010. So you had a low around the same time. Then you had several years of expansion up the first half of the cycle. You had a peak in 2019, and then prices came down a little bit, not 10, 12, 15%. And as you say, because of government actions, the end of the recession, the opening up, things are starting to recover, and you would expect things to continue up on the whole. Of course, local markets, local supply and demand factors, local availability of financing, all those play a part on specific business decisions. But in aggregate, you would expect housing prices to continue up for the next few years. So just on the basis of that small data series, it looks quite correlated to me. I've done a little bit of research on Indian real estate. It seems there was a bit of a financial crisis in 1993, just after sort of liberalization started. There was also a bit of a quite a significant financial crisis in 1973. Suggests to me that actually, despite the fact that, of course, India's approach to business and to the economic policy has changed very significantly over the last 50 years, it suggests to me that actually, on the whole, it's fairly well correlated with kind of large Western economies. And I know now India's larger than most Western economies. And actually, you'll see the same kind of timing as well. But, that's a working hypothesis. We actually have to see how, in the absence of data, how it actually plays out in practice. The great advantage for a business owner in India now is having seen the history in the US and the UK, knowing that it may be correlated, and then being able to watch what's going on there to get some sense of how things will play out in your own locations.
Right. So Akhil, we have the next two slides, which represent a little bit of the correlation of the past few years. And one interesting thing that we found out was, yes, India is correlated to the rest of the world. And when you look at the price index, and especially the price to income ratio, I don't know if Harish can pull that on the screen. What we found that Bombay, Mumbai, and a lot of the other capital cities of developing nations seem to have more expensive real estate when compared to the developed nation counterparts. Why do you think real estate is much more expensive in developing countries as compared to developed nations?
I don't have a definitive answer to that. I think probably that in a lot of countries, it's seen as the ultimate store of value. And so people are prepared to pay much more than they would be in other countries. There's the issue with cost of housing, we're talking about housing affordability, so price to income ratio. The problem with that sort of comparing those data points is that there's no absolute level where housing is unaffordable. So you get much higher ratios in China than you do, China's number 3 and number 4 in the list than you do in the UK or France, even though prices are ridiculous in the UK and maybe not so much in France, but in the UK certainly. So it's I think in emerging markets it's more of an asset where you not only it's for shelter, but it's also a store of value. There are maybe fewer other assets you can park your money in. I don't know if that's necessarily true now, but certainly with older generations, you certainly see those sorts of effects. You saw that to some extent in places like Greece in the 2000s. And of course, Greece had a major property boom into 2008. Does that answer your question?
Yeah, that does.
So, Akhil, some of our members had just tweeted out not tweeted out, but I think they had posted another question in their sign up form. That being largely is we've seen a tremendous pressure on rising input costs into real estate, especially in India. We're looking at an average of about 20% overall increase in the cost of construction. Certain markets themselves are tackling labor issues, like I know Ireland and America, and to some extent Australia as well, are tackling labor issues. What do these issues, which actually sort of inhibit real estate, what role do they play in the cycle? And is it just a way to inflate pricing over time, or what is your view on things?
I mean, I think some of that is it depends on where you're talking about. So when prices rise, let's take different inputs. When the price of land rises, you tend to have to use it more efficiently. So you cram as much as you can onto a particular site within permitted regulations, and you shrimp on costs. So you make the build quality a bit lower. You see that quite a lot in the UK, for example. So all I'm saying is that this isn't a fixed thing. It's a dynamic industry, and different decisions are made based upon different input costs. And so building costs is one of those input costs. I don't know quite how it plays out in different countries. I think that depends on various local circumstances. I do know, for example, in the US, yes, they are having trouble with housing supply, but the reality that is made is that people want to move, people want to live somewhere else, people want to buy, and that is putting upward pressure on prices, which normally ultimately will induce a bit more construction. But the interesting thing about the housing industry is that additional construction never seems to reduce prices, because, of course, as you know much better than I do, one of the skills of being a developer is to feed stock into the market without crashing the price. So you have to do it carefully. And so some of that adjusts. So we might not see necessarily quite the same levels of increase as we've seen out of the pandemic, which was very much demand driven. But I'm sort of expecting that, subject to some kind of resolution or stalemate in the Ukraine-Russia crisis, and hopefully China unlocking its economy, which has I think probably even greater impact on global supply chains, given the importance of Shanghai to the global shipping industry. I think inflation will hopefully start to come down a little bit. Certainly, commodity prices have fallen fairly significantly in the last few weeks.
Aditya, you had something you wanted to.
Yeah, so we've seen recently the Feds have been increasing their interest rates. So we saw a 50 basis point increase in May, 75 in June, and then a further 75 points as of yesterday. In India, the Reserve Bank itself has been following the Feds and has been raising interest rates. You've studied the 1980s inflationary crisis. How do interest rates tie in as a tool to deal with inflation? And how do you think that will affect the cycle?
Well, it worked in the 80s. Raising rates to that level. I mean, you basically, the chairman of the Federal Reserve had to create a relatively significant recession in order to do that. Potentially Powell is doing the same thing, but I'm not quite sure he's really doing it to the same extent. And there are supply factors, which I've just mentioned, which I think will help to bring inflation down regardless of what the Federal Reserve does. In terms of the cycle, well, in moderate to low to moderate inflation, I'm never always sure what economists mean when they say moderate inflation, what number that means. But in moderate inflationary scenarios, real estate is the asset to own. Real estate and stocks of companies with earnings, with solid earnings, particularly where you can pass on price increases to consumers. There aren't too many other assets to own in such things. I mean, in such scenarios, bonds tend not to be great until you've, of course, got bonds which have a suitable rate of interest. So not, otherwise the capital value is eroded. People talk about gold being an inflation head. It's, not done so well the last year, despite the fact we've had very significant inflation. So it's not always a given. Commodities, of course, are another inflation hedge. So there are things that you can invest in, and real estate is one of them. So it should mean that real estate markets hold up until, you know, of course, if people are on variable rate mortgages and suddenly interest rates go up to 10% from 2%, that's of course going to have a major effect. But it doesn't, the transmission of higher interest rates into the economy is not always very swift. It takes several months, and it's, you know, not quite the tool that I think central bankers think it is. So that's kind of my view of what inflation will do and how it will affect the cycle. The other thing to mention, I should have added earlier, is that actually banks want higher rates of interest. It's very hard for banks to make any money when interest rates are at 0%, as they have been in Europe and the US for a very long time. And I noticed the share prices in a lot of banks have, at least in the US, maybe not so much the US, but in Australia and the UK, have held up fairly well over the last few months, as you know, the full scale of the conflict has become apparent. In other words, where it's sort of limited to and so on. And so the other thing that fuels the second half of the cycle in particular is the availability of bank credit, as I've mentioned. And so if banks are making money, they're, you know, better capitalized, they're more willing to lend, and that can fuel a boom. So actually, I don't see inflation particularly being too much of an issue for the second half of the cycle, at least from a real estate point of view. Now, again, subject to specific conditions. I'm not an expert on the Indian banking system, I'm sorry to say, so I don't know if there are the constraints on the supply of finance, etc., which would affect things a little bit. But those are the major sort of underlying dynamics.
I know you touched base a bit on, COVID being a factor. Just if you can elaborate a little more on how it affected the cycle, and whether there'll be any long-term effects because of that.
Well, there have been a couple. I don't long-term. Yes, I mean there's always a long-term effect of pandemics, but in relation to the cycle, there have been a couple. So as my sort of contention is that we were slowing down into a recession or a slowdown at the end of 29 anyway. What the pandemic did is we basically were asked to stop doing everything, work from home where we can, but very major disruption to the economy. But the public policy response to that in most countries, both developed and emerging markets, was to enact one of the biggest fiscal stimulus programs we've ever seen. And that a lot of that was direct to households, at least in the UK and the US. And that created a massive increase in the rate, in the savings rate, which when economies started opening up, meant there was a huge surge in demand. But the supply side of that was not able to respond because, lockdowns were still happening. And so I think this is one of the contributory factors of inflation, which is one of the reasons why the chairman of the Federal Reserve for quite a long time was saying that inflation would be transitory, partly because he expected supply side to respond. But of course, we hadn't had second lockdowns and China third lockdowns and so on. And so it wasn't so easy to get that side. And then, of course, on top of that, the Ukraine disruption. So COVID has disrupted supply side of the economy, and it's also created enormous demand because of the nature of the stimulus packages. This will have quite a long-term effect. It will take some time to play out. The other thing it appears to have done is firstly take a lot of people out of the labour market and then brought a lot of people back in, but maybe not quite to the same extent and not enough to meet this additional demand that we saw in 2020, 2021. And so there's been quite a significant rise, at least in certain industries, in wages, which of course has an effect on pricing and so on. And interestingly, the consequence of a lot of pandemics is that wages increase. Might be because a lot of workers have died, and so the ones that are left are being chased, and so you have to pay them more. But also in this case, it's changed the composition of the labour force. It's changed where people want to locate and so on, and so adjustments have had to be made as well.
So, Akhil, if I could just, one of the questions being asked in this particular forum is, what do you think is going on with the Chinese real estate situation right now, and how does it affect the larger global property market?
Yeah, I mean, this is a question. I don't really have a very clear answer to this, I'm afraid to say. So, at the end of last year, with Evergrande about to default on its loans, people were saying it was a Lehman moment. But, the Lehman moment happens at the end of the cycle, not the mid-cycle. That's the first thing to say. The second thing is, the Chinese government is in control of its economy in a way that most Western-style countries are not. And it can direct people to stop buying, it direct people to buy, it can direct lenders to lend, it can stop them doing so. And so it appears that it has contained the problem without, of course, solving it, because you can't solve it when a big company is over leveraged and so on. It's not so easy. So I do think that it will have an effect in the Chinese real estate market. Whether it has an effect globally, I don't know. I don't think so, but it certainly hasn't so far. What I think the outcome of all of this in the next couple of years is it won't create a major problem. Then people will think, well, the Chinese government is all powerful and can control its economy. It will give investors in China more confidence. They will go in even harder. Chinese banks will be going abroad. I mean, they're already abroad, but they will be going abroad in even greater numbers, the Belt and Road Initiative and so on. Some property markets outside of China will be quite dependent on a flow of Chinese capital. And at some point, the Chinese government, when things have become over-leveraged in China, and probably at the same time as they become over-leveraged in Europe and in North America, the Chinese government will take some measures to stop that flow of credit outside and maybe tell banks to capitalize more and so on. And they will have to respond, because you have to do that sort of thing in China without fail. And that might be the thing that precipitates the next crisis, because when you lose credit from an economy and you're dependent on it, it can have very significant consequences. And the thing is, because we are now much more, at least from a financial point of view, much more globalized, that could have ripple effects all around the world. And so that is my prediction for how the Chinese real estate and banking sector might influence the rest of the cycle.
Thanks so much for that, Akhil. We're drawing close to an hour, which is what this session was supposed to be. A few closing notes, if I could put, take advantage of your goodwill and extend this session. Property share market economics runs a service. What is the advantage of this service? Why should I be interested in it, per se? And how is it different? How do you guys tend to help your members?
Well, I mean, you should be interested if you've found what I've said useful. If you thought it was a load of rubbish, then probably it's not for you. So what we do is we track the cycle, particularly in Western markets, but we're increasingly looking at places like Japan and India and other places, and hope to do potentially more research with you to develop sort of local indicators to track the cycle in India. What we do for our members is market commentary. We have proprietary indicators that we use to show them where they are. We filter out the news and we relate it back to the cycle, so people don't get too scared by, let's face it, fairly hysterical headlines in the newspapers all the time, knocking your sense of balance all over the place. We produce an annual stock market forecast for the US, Australia, and the UK, but other countries if we can find the data. So we'll try Japan, etc. And that has proven to be fairly prescient. So we were telling our subscribers that the high for the year would be around February, March, and that we'd have a pretty significant low in the middle of the year. So we've been pretty accurate, and this is not the only year we've been accurate. We tend to have a fairly good model for the stock market, and so that can be advantageous. And then we keep tabs on what's going on in real estate and in markets and in the banking sector to check that the cycle is on track. So really, the advantage is you have a sense of security that you know what's going to happen, that we will have your back and telling you when things are turning down, and hopefully some ideas for how to take advantage of the cycle from a real estate or a stock market point of view.
Great. So just adding on, as developers, we are driven by constant need to just acquire, and acquire, right? How do you and property share market economics suggest a real estate developer or to navigate through the booms and the busts? That's the first part of my question. And without getting into detail, how does property share market economics strategize for a developer, or the strategy for a developer differ from the advice on the ground level or the ground reality?
Well, I think you sort of answered your own question. So it's all very well buying and buying and buying, but at some point you have to stop. And so we will tell you when that point is. Essentially, we're not going to tell you, you should invest in this district or that district because you know much more than we do. We can tell you that, of course, if they've expanded this, the city limits. And if they suggest they're building train lines and roads out to districts, we can provide advice on the basis of what we've seen in previous cycles, is that the cycle always ripples out from the center to the outlying suburbs and outlying regions. In the second half of the cycle, they increasingly go to areas where there's a thinner population, thinner demand, which is much more volatile. So it goes up much more quickly in the second half, but also comes down much more quickly when the crisis happens. We can also, and I think this is the real advantage of being in India and other countries compared to the US, is that we particularly follow what's going on in the US, not least because it's still the world's largest economy and the world's most significant financial market, but also because it tends to lead the cycle. And so what happens in the US 6 months in advance will happen in the UK, which will happen 6 months later in other parts of Europe, and potentially in emerging markets as well. So you've got plenty of advance warning, which is important for a real estate developer, because of course, if you've got stock to shift, it's not like you can just sort of sell it straight away. You need to prepare, 2 or 3 years in advance to be ready, and that can sometimes involve some difficult decisions. Sometimes foregoing business, not starting projects, not taking on additional staff, which might seem like a ludicrous thing to do at the time, but actually means that you're prepared and protected when the crash happens.
Akhil, in consonance to what you said, Harish, could we just have that last chart where just for our members out here? And I don't want to spend too much time on this, but just to highlight how relevant that information. Harish, are you there? The last slide, please. The last slide. Yeah. So this is Mumbai, and then the extended suburbs of Mumbai, which is Panvel, and Thane, which is called the MMR region. Harish, back to that slide. Ironically, in line with what you said, Mumbai, Thane, and Panvel, these three, Thane and Panvel are extended suburbs of Mumbai, essentially, in some way. And they've grown far more than Pune, which is more like an isolated developed city or developing city. And, it's the sheer amount of infrastructure being built to connect to the main city, which sort of has prompted this kind of growth. But yeah, that's just a small point I thought we could highlight, and we could thank CRE Matrix, our knowledge partners, for this. Aditya, you had something you wanted to share?
So one last question from my side, Akhil. I've been quite addicted to Phil's book, which is The Secret Life of Real Estate and Banking. Sorry, I'm bringing this up again. And I believe it's one of the most comprehensive readings in real estate that I have gone through. I now hear that someone else is also coming out with the book soon. So if you could just talk us a bit about that, and also how does your book differ from Phil's work?
So the great secret is that I'm writing a book, or I've written one. It's now with the editor for editing. So it's called The Secret Wealth Advantage. And essentially what it does is, unlike Phil's book, which provides a comprehensive history of the US real estate cycle since 1800 and shows you, I think you'd agree, in quite some clarity how the real estate cycle repeats. I take a lot of that knowledge as given. What I do is I break the cycle down into about 8 stages. And I illustrate each stage with a different episode from history. And I tell people, here's what you need to look out for at this stage. and then I give them a set of investor actions or business owner actions to take advantage of that phase or to protect themselves. So, for example, the mid-cycle slowdown, one of the actions is make sure that you have a lot of spare cash if you're a business owner. Make sure you're not over leveraging. Make sure you can cover your loans. Make sure you haven't overexpended your staff such that you might have to fire some of them, etc. And the advantage of that is when things come crashing down, or not crashing down, but when things come down in the recession, people who have gone over the top have to, they lose market share, and you're in a position to expand because you've got cash and you're prepared. You can grab that sort of share off them. So it's things like that. It's how to take advantage of the cycle stage by stage. And then in between all of those kind of sequential practical chapters, I also explain why the cycle happens, why land is so important to the cycle, why no one sees the cycle, how commodities play in, how banks and government spending has an effect, how when the banking system has been rescued, because that has to happen at the end of the cycle in order for the next one to begin. So it sort of explains the cycle, educates people about it, but then also tells them what to do.
Wow, sounds really interesting, and a cheat code in the true sense for, I think, all of us. So I think on that note, we're super excited to, for your book launch. And hopefully when you're done with that, we'd urge that you do come visit us in India. We'd love to host you. And just on behalf of the developer fraternity and CREDAI MCHI, we'd love to hear more from you and the different phases of the cycle. So we're eagerly awaiting your book launch. And I think never before you've kind of opened our eyes. We've realized about the cyclical pattern and nature of our businesses. So thank you for that. And I'll just hand it over to Ricardo for the closing remarks.
Yeah, I think we've already extended our time, Akhil. A big thank you from all the developers from CREDAI MCHI, CREDAI National. Thanks for taking out time. We hope we can host you, as Naman said, at some point in time. If you're doing a book launch tour, that would be fabulous. And maybe we could also toast you more than just host you. So on that note, Akhil, anywhere we can reach out to you. I know a few people have their questions unanswered. So how could they reach out to you? And if you'd like to drop that bit of information.
Probably the easiest way is if you email the team. So info@property Sharemarket Economics, all one word, .com. And let them know you've got a question for me. I'll get it that way. And as I said, you're welcome to become a subscriber. There is a free newsletter, so you don't have to pay any money if you don't want to, or until you're ready to. So if people want to keep up to date with some of our thoughts on a weekly basis, you can sign up to our blog, which is available via the website. And of course, if you're more interested in knowing more, then you can become a subscriber as well.
All right. On that note, thank you once again, Akhil, and hope you have a good evening or good day ahead. I don't know where you joined us from, because you've been super secretive about that as well. So,
I'm in London. It's 2:30.
Oh, okay. So a good day, hopefully. Ahead. Yeah. All right. Thanks so much. Thank you, everyone from CREDAI MCHI, CREDAI National, for joining this session. We hope it was informative. And if you would like to message your question in, and we could take it forward into a more consolidated form to Akhil, maybe we could try doing that at a later time as well. Thanks, everyone, guys. Have a good evening.
Thank you so much, Akhil.
Thank you very much for having me.